So it's no surprise that politicians will be politicians. Now, Biden's administration just announced that they're going to do a 1.9, well, let's just do $2 trillion stimulus package. And this was the 2 trillion discussed several months back, all the way back in summer with the Trump administration, and Nancy Pelosi wasn't on board with that. So now we have 2 trillion, and it's going to add to the additional $27 trillion that the United States is already in debt. But let's focus on the signal and not the noise, and we're going to show you exactly how to do that when we follow the money. My name is Joshua Belanger, and this is another episode of Follow the Money. So we're going to take a look here at the IWM. The IWM surprisingly has been ripping higher since the election announcement, or the aftermath of the election. We've seen prices continuously soar higher here and hit 215 on the IWM here. This is the ETF. Now, when we look at this, it's had such a surge higher, we can almost look back to the tech rally that had happened after the lows in April. And we saw a little bit of a pullback, and here we're starting to see a little bit of, I wouldn't say exhaustion. I mean, it's from 164 to 319 in nearly less than a year. I mean, that's a pretty significant move. One of the things I would be looking at as a holder of stock here is to manage those profits. Because what we're seeing here is, especially when you look on this Q here, we're starting to see this for technical traders. You start to see a little bit of that top, that rounded top. It's almost an exhaustion. It's frothy at this level here. If we take a look here at the SPY, not so much forming here, but again, tech has led, and either one of these other indices are going to have to pick up. But when we see these levels here, it's kind of you have to sell into this move, and you can always buy at lower prices, but you got to manage profits. That's something that I always preach. So specifically talking about IWM and following the money here, when we take a look here at the volatility in the Russell, which is known as the RVX, we had a big move in that 88 and pulled back here, and we've been right around 30. Now you see, when you see volatility kind of compress like this, and the reason why it's holding a bid, meaning buyers are there, but almost the same way you see this, you start to see a little bit of a formation, almost a kind of a move higher. It doesn't necessarily mean volatility can go higher without prices necessarily going back, but when you look at the IWM here, to me, I just think, hey, look, how do we hedge? Even if you're long, you still want some hedge, some type of hedge that can play out. Now, if you looked at gold for an inflation hedge, it hasn't really worked out so well. So one of the things that we will look at here is a directional bet. We'll follow the money, and let's take a look here. So one of the trades that we picked up today in this IWM ETF. Now, it's tough to put so much weight onto it because these ETFs have institutional money, and they're always balancing their portfolio. So that's why I don't typically focus on ETFs for following the money, but just taking a look at where we are at on the IWM and seeing some money flow into it, you start to put some assumptions together and also some trade biases as well. So we take a look here, and we'll take a look here at the 29 expiration. It expires in 14 days. And one of the things that we see here is the 204 put traded 16,000 times, and this actually traded at one trade. It was executed not on a platform. It was executed picking up the phone and calling a broker. But they bought the 204s and they sold the 194s here. So this was the position here. It kind of went down a little bit too far here. So 194, that's the strike that they sold, and they bought the 204. So that's a 10-point spread, and I don't have the exact price. 29,204. I mean, I'm not going to add it up. So anyways, it's a 10-point spread, and if we just take a look here at this 10-point spread, they are looking for prices to snap back all the way into this level here. Now you look at that and you say, well, that's not really that big of a move, and we can actually quantify that. It looks to be a move of, let's take this right here, and that would be a move of about 5%. So we've seen moves like this, and what you want to do is you want to compare it to previous moves. We saw a snapback here where prices actually declined nearly 12%. So my prediction, my assumption is that we actually see a pretty sharp pullback. You just think about how markets work. I understand how markets work. You get a shakeout, and we've seen velocity. The move in stocks are always more extreme to the downside than they are to the upside. They take the stairs higher and take the elevator lower. It's exactly how it is. We've seen that in the IWM. And what we could look here is, I don't know necessarily if 14 days, for me, putting my money on the line is going to be that beneficial. What I would look for is 35 days is good, but I actually would like a little bit more time, and I would look into something into March. And you could position this spread in any way possible. You could buy, you could do a 5-point spread, and that's the good thing about the ETF in general, is because you have dollar strikes in between. So even if you have a small account, a small Robinhood account, or you have a bigger account, the good thing is that you can create your spread in how you think things are going to pan out. Now, timing is always important. So you have 63 days on here, and you're selling the other put at a lower strike, so you're offsetting that time decay that could happen. So the thing to keep in mind, though, is because you sold that lower put, implied volatility, if prices do crash lower, will increase, and you won't make as much money as you necessarily would with just being a long put. But that's the trade-off, and that's what you have to look for. So the long put will have decay, but also benefit in extreme volatility surges that go higher. So that's a little options 101 for you. But listen, the stimulus that's coming out is a bubble in the marketplace. It's understanding how the market's played and how to profit from it, and that's why it's essential to continuously, when you have profits, manage those profits, take that money out and do something else with it. Keep stocking it away, do some other things with it, because inflation at this point, when we add another 2 trillion on to the 27 trillion, I mean, in 4 years of Democrats, the amount of debt that we can take on could exceed 35 trillion, and it's something that is concerning. Gold's not reacting as it should, but the fact that we just continuously spend or add on is concerning. You have to worry about your money. Managing your money is not only about making the money, but how to protect it as well. So that's what I have for you today, and I will talk to you in the next episode. Make sure you like, make sure you make a comment, good or bad. Don't be hiding, good or bad. And also like, comment, and subscribe. See you in the next video.